All right. Well, good evening, everyone. Welcome to the MIT Enterprise Forum of the Central Coast. I'm Steve Saraboff. I am the chair of the MIT Enterprise Forum of the Central Coast, and it is my great pleasure to welcome you all to our event tonight. And when I say you all, last check, we had somewhere north of 220 some people who were signed up for our event. That's pretty darn good. When we are in person, 150 is a really good room. 200 is a fantastic room. And here we are virtual and we're blowing through that. And we had a really great event last month. If you joined us, you learned an awful lot about technology and the elections. And hang with us tonight because we've got a really fantastic program entitled StartUps, Funding to Flourish. Some special things for tonight. One is we have some new technology for you. One of the things that so many of us really love about our in-person events is the opportunity to network with other people before the events and of course after the events as well. Thanks to a really hardworking special committee of our board, we have set up a service called Appreciate, and Appreciate's got a special thing called Social that allows us to do person-to-person and small group networking. It's really fantastic. We've done a couple of trial runs. We really love it. And so what you'll see is probably in the chat, the Zoom chat, you'll get a link. You'll be able to see a link for Appreciate Social. I would suggest at some point, sign up for it. Now, here's something else that's important. Because Appreciate Social is relatively new, it is limited and our rollout is new. We're limiting the number of participants to 50 people. So the first 50 people get in the room. I'm really sorry. If you snooze, you lose. You're going to miss out. Those of us who make it into the room, if you're not entirely satisfied with the experience, you'll get a bamboo steamer and you can keep the bamboo steamer and maybe some Ginsu knives. But in all seriousness, so we've got that. So that'll be networking at the end of tonight. And we'll run that for probably at least half an hour. The other thing that's different than usual is how Q&A is going to work. Of course, the A will certainly come from our panelists, but the Q will be coming from all of you as people in the audience, but the questions are going to have to come through Zoom. And if you look down at the bottom of your Zoom window, you will see next to chat, there should be a link for Q&A. So you can submit your questions through the Q&A link in Zoom, and the folks on our end will consolidate and sift and do our best to make sure that all of your good questions are asked to our panelists. Some other housekeeping. I want to make a special thanks to our sponsors because we couldn't do this without our sponsors. Our premier sponsors include Bank of the West, Falver Large Archibald Spray, Nassif Hicks Harrison Company, Pacific Coast Business Times, my law firm, SoCal IP Law Group, Stradling, the Santa Barbara Independent, Chill Strategic Partners, and Founders Capital Partners. And what I would even suggest is check out the mitcentralcoast.org website for the full list of sponsors. They're really wonderful people, and we really do appreciate their support. And if you're interested in sponsoring, contact us, and we'll see what we can do for you. Even if you're not prepared to be a sponsor, as you know, tonight's event was entirely free for anyone who's joining, but we are accepting donations, and we really do appreciate your donations. We are a nonprofit. We are run based on both the sponsorship and the revenue that we can generate, the small amounts from our events, and there will be a link again in the Zoom chat where you can click on that. You know, if you came to us live, it would be $50, I think. Be generous. Give us $20, $15. That would be really great. Other things, fun stuff, upcoming events. Next month is our November event, and it will be as usual on the third Wednesday of the month. That is called Buy Their Own Device, and it's all about medical devices, and not just the devices themselves, but in particular, the business and the local business of medical devices. It's going to be a really fantastic program. I'm really looking forward to it and hope to see you all there. Now let's get to our program, StartUps, Funding to Flourish. Our moderator tonight is Jason Spivak. Um, I have known Jason for probably about 20 years,
Yep.
and had the great pleasure of being on the other side of the table from Jason in a deal. We didn't get to do the deal together, but we developed a relationship, and I've had the pleasure to work with him on and off over the years. One of the things that I really love about Jason is his restless energy. And you see that over and over again. So his restless energy. Jason is a teacher at UCSB, but because of his teaching at UCSB, that led to his relationship with Appeal Sciences and his very active role in Appeal Sciences, which has been a really great success for the Santa Barbara area. Jason is also one of the founders of the Santa Barbara Angels Network that eventually led to his founding of, or co-founding of, Entrada Ventures, which is a very active local venture firm angel fund. And I think what you're going to see tonight is a reflection of that restless energy, where he is really knowledgeable and very on top of things. He's going to do a really fantastic job as rolling us through all of the different panelists. And what I'm going to do now is I'm going to hand off to Jason. I'm going to return at the end of the presentations, so that I can close out our event and one more time urge people to join us in the Appreciate Social. With that, my friend Jason, have at it.
Thank you very much, Steve. I really appreciate it. I really appreciate the chance to be here with this group of people. I'll introduce who we have here and give them a chance to introduce themselves and give a little bit of background there. What I love about this group of people is I know everybody here, and some of the folks I've known for a really long time and have had a chance to work with over and over again. And we've got great depth of entrepreneurs here, as well as everyone that we have here coming from a Capital Voice has also had substantial operating experience as a startup founder and scaling leadership team. So we get just a killer group of people. Let me walk you through who we have here quickly, and we'll turn it over to them to share their backgrounds. As we do, I want to kind of reinforce what Steve said. We really want to make this as interactive as possible. So as you have questions, as something you hear is triggering a thought or a question for you, please throw it in the Q&A. We'll do our best to get to everything. Leslie's going to help here and make sure that we're sifting through the questions. But this is really not about us getting our own questions answered. It's an opportunity for those of you who are interested in learning more about how to raise early stage capital. You may be in the process today. You may be thinking about it for the future. Help you understand the do's and don'ts and sort of the tricks of the trade and the experience that all of these folks have had. Both Haley and Andreas, who you'll hear more from today, are in capital raising mode right now. And so we've all been there. It's an exciting time. I'm looking forward to diving in, and please do bring your questions out. There is no dumb question, right? If you're interested in, chances are lots of other people are as well. I love doing these things on Zoom, as crazy as that sounds, because, I mean, show of hands, who's wearing pants right now? I mean, so not too many folks, and you also don't know what's going on in people's worlds. I'm looking out the window here and watching my wife and daughter chase ducks around the yard and try and corral them right now. So it's all good, and I'm looking forward to diving in here. So with that, let me just briefly tell you who we have here. In no particular order, we have Elizabeth Chalowski, who is the CEO of HG Insights and CEO of multiple companies and active angel investor as well. We have Dan Engel, who is again an operator and founder turned angel investor and now launching a new venture fund, which I'll tell you about. We have Andreas Forsland, who is the CEO of a startup that's also scaling here in town and raising money, and he'll tell you about that as well. We've got Brett Queener, who is a longtime friend of mine, a board member at Invoca with us, early executive with some of the biggest software companies in the world, and now active as both an angel and as a venture capitalist. And who am I missing here? Is that it? I think that's it. I can't see on the screen. So anyway, with that, let me turn it over to the folks to share their backgrounds. And again, in no order, Haley, would you mind just stepping up and sharing a little bit about your background and your story?
Sure, I'm the one you forgot, Jason.
I said Haley first, didn't I?
All right.
Said me, it's so easy to confuse the women, Jason. Don't worry about it.
All good. But yes, happy to dive a little bit into my background. So hello, everyone. My name is Haley Pavoni, and I'm the founder and CEO at Passion Footwear. We have created the world's first fully convertible high heels. So I find it's easier to show than to tell, obviously surrounded by shoes. But essentially our product is a high heel, comes up, and you have a flat. So 2 shoes in one. I'm biased, but I think it's pretty brilliant. Fun fact about me, I actually started this business when I was a junior in college at Cal Poly SLO. In the 4 years since, we just turned 4 on October 4th, I've obtained patent pending status in 30 countries on this design, obviously fully developed the technology, built out and trained the supply chain. I've raised about $3 million to date in venture and angel funding. And I'm happy to say we formally launched the brand, product, and e-commerce operation in June of last year. And we are—
Haley, I hate to say it, I hate to interrupt, but we have a lot of people responding. They can't hear you very well. Maybe get closer to your, sorry, but you're hard to hear.
Okay. I don't know what to do about that, but I'll just get closer. Hopefully this is better. But my last note was just that we are on track to do our first million this year. So we're very excited about that.
That is awesome. And this is the full disclosure part of our show where I forgot to mention that Entrada Ventures, we are investors in Haley's company. And what really drew us in was not the shoes per se, right? I heard Brett kind of ooh and ah, so he probably needs a pair. But we were really drawn to Haley as a founder. And sometimes you meet people and you think, this person's just going to be super successful at whatever they do. And I hate to make you blush, but Haley was very clearly in that category for us from the day that we met her. And so my partner, Julie, has been working closely with Haley and the Passion team here, and we're really excited to be a part of that journey. So throwing it out there, Brett, what size shoe do you need?
My feet keep shrinking, so I don't know. 9.5.
Perfect. We'll make that happen for you. My pleasure.
All right. Congrats on the million milestone. The first million is always the hardest. So I'm Brett Queener. I'm a general partner at Bonfire Ventures. It's a $100 million venture fund based in Santa Barbara and Santa Monica. We solely do seed stage investing in B2B software with a strong preference for Southern California. Prior to Bonfire, I spent 20 years at some of the fastest growing software companies as an early executive at places like Salesforce.com and Siebel.
That was good and short. Awesome.
Would
Would you mind sharing your background?
Who did you call on?
Elizabeth, if she's there.
Oh, yeah. We missed the name. Yeah, happy to, Jason. Thank you. So currently, as Jason said, I'm running HE Insights, which is a big data company in Santa Barbara. So we're very pleased to be growing a substantial technology firm in the Santa Barbara region. So that's exciting. My background has really included quite a range of companies. I've been in a number of startups myself. I've been at larger companies with Citrix through to its growth, Citrix Online, to well over 600 million from the very early days there, and also running public companies up in the Bay Area. But really my passion is staying connected with startups and with helping startups. I'm a member of the Santa Barbara Angels Alliance today. Thank you, Jason, for getting that off the ground so that when I came back to Santa Barbara—
That was not me.
There was an organization that was really out there ready to try to help in the angel round. So I advise a lot of companies and still keep my hand in that, and hopefully can offer some advice tonight that is useful for you all.
Thank you. I'm glad that we have representation from Santa Barbara Angel Alliance, SBAA, here, because it really has shaped up to be the most active angel investment group here on the Central Coast. But I do want to be real clear that that really is the brainchild of John Patoti, who is instrumental in bringing us all together on that. And so with that, I'd roll over to Andreas. Give us your background.
Hey, everybody. Hey, my background. Wow. I've been a Santa Barbara now for a little bit over 10 years. So I came to Santa Barbara to join Citrix, actually. So I was early on, I joined Elizabeth, and she and I worked together for about 5 years from 2008 onward. But shortly after my time at Citrix, I started a company called SmartStones, which is now called Cognition. So what Cognition is doing is we were essentially creating neurotechnologies that make it possible for people with severe disabilities to be able to access technology. So we're building a product essentially that converges augmented reality with a brain-computer interface, basically EEG sensors. And so it's a wearable device that people with disabilities like Stephen Hawking, if he were still alive, could wear, and he could access the internet, communicate, control his smart home. All of that is possible with the technology we're building now. So prior to coming to Santa Barbara, I worked at Philips. So I worked internationally as a design strategist within Philips across their healthcare, consumer electronics, and their lighting business. And I helped them figure out what was sort of next. So working with the lighting business around what's after incandescent, getting into solid state lighting, within consumer electronics, what's the future of technology regarding consumer electronics and so on. So my background's design and innovation, but what's really cool about Cognition is we can couple that science and technology with actually impacting the world positively by helping a lot of people. So our technology right now is also targeted for medical insurance reimbursement. So right now we're dealing with all the regulatory stuff and all those things that I wouldn't wish upon anybody, but needs to happen in order to bring a pretty remarkable product to market. So yeah, so that's what we're doing right now.
That's awesome. And we've had the chance to see the technology at work, and it is amazing. So, and last but certainly not least here, someone that I think many of you know here in town, Dan Engel, who at a relatively young age, he's not quite as young as he looks, I would have to say, but has had the entire journey from being a part of a founding team of companies that have grown to be brand names in technology, to starting his own very successful company, to success as an angel investor, co-investing with us in Appeal and probably other stuff, and now launching his own venture fund. So Dan, would love to have you share some of your background here with the group.
Yeah, sure. Can everybody hear me okay?
Yeah.
Yeah, you can hear me okay, Jason?
Yeah.
Okay, great. Thanks for that. Appreciate it. Yeah, so I've been in Santa Barbara since about 2001, and I run Santa Barbara Venture Partners. We are a venture fund that focuses on companies that do generally later stage where revenue is already pretty significant, maybe 3-4 million up to 10 to 15 million for the majority of our funds that are growing at fast clips. And we do minority of our investments in early stage companies we think can potentially be billion-dollar companies that are able to be in a place where demand is not really such an issue. It's more about execution, like Appeal Sciences, for example. In terms of my background, so I started a company in college that was one of these .coms that I learned an awful lot from. It ended up fizzling out in the .com bust. I became an entrepreneur in residence at Idea Lab, which is kind of the original incubator. If you've ever heard of like Y Combinator, they were the Y Combinator of the .com days. And my job was to build software and other types of companies that could go public potentially during that time period when .coms were going public. I ended up with working on GoToMeeting and GoToMyPC, remote access and remote meeting software products, where I did majority of the customer acquisition and revenue generation and online and offline marketing. And we ended up selling that business to Citrix, and they resold it for 1.8 billion to log me in. Then I went on to work on Picasa, the digital photo software, which we sold to Google, and today it's Google Photos. I also led their customer acquisition and revenue generation. At Google, I was in charge of all their customer acquisition for AdSense and AdWords, their main products. And then I decided I wanted to start a company again from scratch. So I started FastSpring in 2005, which is kind of like Stripe. It's web store management for about 4,000 software vendors. It's a little slow going early, but we finally got things to catch on. And after about 3.5 years, it became a very fast growing company, one of the fastest growing in the world. We sold it a couple times. We had invested $30,000. We bootstrapped it. And by the end of it, we had sold it. It had sold for over $100 million. So a lot of struggle and then a lot of success with a small amount of resources. I did a lot of angel investing, including Appeal Sciences, like Jason mentioned. And then I worked for a couple of venture funds, OCV Partners in LA and NGen Partners, which used to be in Santa Barbara, but ended up being a New York firm. And they're about $250 million funds. I helped them find deals and then decided to start Santa Barbara Venture Partners about actually this year. So that's the new business.
Great, thank you. So we got a lot of very accomplished folks here, a lot of humility, and people who are still engaged with early stage startups because we all kind of love the sport, frankly, and love interacting with great motivated entrepreneurs. And we have a couple of those folks here with us right now. So I know the focus here is primarily on capital, right? Many of the folks tuning in are trying to figure out, how do I get money? So that's kind of a walkthrough. I think both Andreas and Haley have interesting and fresh journeys to talk about. And I thought maybe we'd kind of progress a little bit through the stages of capital. And let's start with kind of the friends and family angel realm of capital. And so with that, we got a lot of questions. I'm going to try and spread them around here. I appreciate you guys giving me some feedback on that in advance. So I'm going to toss it out to Haley just to kick things off. So Haley, when do you think is the right time in a company's development to seek outside capital?
Absolutely, can dive into this. First, I just want to clarify, can everyone hear me? Are we good?
You're still pretty quiet.
I don't know what's going on. Okay, I'll just get really Italian and talk as loud as I can.
Perfect.
That works. Okay.
Stay back far enough that we can see your hands moving though.
Yeah, this will be this is all you really need to see regardless. But anyway, as far as when it's time to raise capital, I think it depends on the goals that you have for your business and also the type of business that you're building. So for me specifically with Passion being a product business that eventually has to hold inventory and obviously required a lot of upfront investment in engineering, testing, and then also we have to make molds and tooling for production assets. It was pretty clear for us that we needed to fundraise as soon as possible. That being said, when you're small, you can be scrappy, try to use as many free resources as you can. I was able to bootstrap the business for the first year based off of winning pitch competitions and taking that prize money. And then also being a full-time student at the time, I was able to take advantage of a lot of university resources. So, there's always ways to get scrappy and try to stretch the dollar as much as you can. But there always comes a time in your business where you have to kind of ask yourself, how fast do I want to get where I'm going? And can I realistically do this without an infusion of capital? So again, if you're a product-based business, that necessity side of it will come into play much earlier. After we had our first couple prototypes 3D printed, it got to the point where it was, okay, we have to make a real shoe. You can't really find cobblers anymore. So that means making mass production assets, which cost $300K. And when you're 21 years old in college, your only option is to go fundraise for that kind of cash. So for us, the decision was pretty natural. But I'd say you'll always, as an entrepreneur, either come across a time where you need it for reasons such as that, or you want to accelerate your growth. So you've gotten as big as you can, as quick as you can. And what you really need is that infusion of capital to take things to the next level. At least for us, it was very apparent when that was. And I think most founders can kind of recognize when you need to take a step up on the funding side.
Yep. I don't think there's any right answer there. Each path is different, and it's been interesting to watch you kind of move through these iterations now as well. Dan, you've pretty much tried on every flavor of investment capital out there so far. So at a high level, right, I'd like to help calibrate for the audience sort of what the different options are. What do you see as the different types of growth capital available to startups?
Well, there's lots of ways to go about raising money. And first and foremost, I also support, bootstrapping if possible, because once you raise money, often, you get this clock that starts ticking when you have to accomplish certain things, and you lose a little bit of control over your destiny. So even though I'm a venture capitalist and an angel investor, I do encourage entrepreneurs to see how far they can get without going too far in raising capital and getting that clock started. With that said, in terms of different ways to raise money, so, there's angel investing, which, there's friends and family, people generally. that are going to be easier to raise money from in some cases because they know you might want to be supportive. Then there's angel investors who are folks that theoretically have experience investing specifically in companies. They might be people you know, they might be people who know people you know. There's lots of those people in different places that make themselves accessible. Some are members of angel groups like the Angel Alliance we have in Santa Barbara. Others kind of stick to themselves and you kind of network yourselves to them. Then there are venture capital funds. There are micro VC funds like mine that's smaller. Then there's larger ones. Obviously, there's the multi-billion-dollar ones that are more appropriate for later stages and things like that. But then there's, it's a question of what type of fund and situation do you want. So, the bigger funds tend to come with them all sorts of terms and potentially control issues and issues that maybe some of the smaller funds are not going to have to deal with. They won't necessarily handcuff you for the things that you're going to be able to do.
Yep. We'll dive into the different term structures here a little bit down the path, because we want to make sure everyone understands the different sources of capital, which you just walked through, right? Bootstrapping, friends and family, angel investment, micro VCs, traditional VCs. There's crowdfunding out there, right? There's debt, obviously. There's non-dilutive capital like grants, which you can have a couple of birthdays trying to get, but it's awesome when they come in. So we'll kind of move through a couple of those. I think that people are probably interested in understanding that, but sitting there going, how do I access that, right? So Elizabeth, I'll just throw it out to you. What guidance would you give someone if they wanted to access angel capital and didn't have a lot of connections for it?
Yeah, so first of all, the Santa Barbara Angel Alliance is trying to do a lot better job of making that easier, because there's about 30 members at any one time in the group, and we haven't done a great job of just having a website where you can see who we all are. But in a small town like Santa Barbara, it's usually not too difficult to call somebody up and get an introduction to a group like SBAA. So networking really ends up being the entree into a group like ours. And then once you connect with somebody in the group, our job, if we're part of it, even though it's all volunteer and we're doing this because we want to be good angels, is really to listen to where the person is and what they're doing. That's the role that we play as part of the team on SBAA. So it's not going to be hard once you get a name to get the time to actually explain your idea and where you're at. That's what we want to hear. And then from there, it's our job to get you into the group if you're at the right stage and for a good discussion with the team members.
That's great. And at least in my experience, the most effective angel investors are the organized ones, not the individuals who are out there just sniffing around trying to find their nephew's, brother's, neighbor's deal to go throw a check behind. Before we roll on to exploring more traditional venture capital here, I want to dive in a little bit further on the angel perspective, because as Dan kind of hinted at, different scale of investors bring different levels of overhead with them as an investor, right? Certainly different resources, but also different impact on your business. So Andreas, you've been through the process of raising angel money. You've brought in non-dilutive investment, right? Grant money. I would ask you kind of, why is an angel investor attractive for you as a founder entrepreneur?
Well, first, I think you guys hit it on the head. It's like the further along you get and the bigger the checks that are written, the more entanglement you get with your term sheets, right? You have all kinds of things that get leveraged. The further on you go, it's all about the economic leverage or the control leverage. And it's always negotiating between those two things the further you get. When you back into, say, an angel investor, usually, like the folks on this panel, you're dealing with people that you like, that you can literally roll up and have dinner with, and they treat it as a passion, right? They're passionate about doing it. It's a part of what they're doing. They're investing their own money, so they're putting their own skin in the game. Whether they're putting their skin in the game in like an investing club or an alliance, or they're doing it just by themselves. So angels tend to have a higher risk tolerance, but they also obviously they wouldn't be in a position to be able to make angel investments if they weren't smart with their money and had a portfolio that said, I can take these risks. So I think it's really much more around at that really early stage of an organization where you need a lot of help and you might need advice, and you might want to rely on an angel that you really enjoy working with, that you respect. And there's a bond, a mentorship that can happen there, a friendship. And I think that's something, if you're looking for someone to help make you a better professional, to be a good sparring partner, to give you ideas, to help you become a better founder, I'd say angels are definitely the way to go.
That's great. And I want to dive a little bit deeper into kind of what the VC world looks like and how you access that. And I have a couple of questions for Brett, but I'm going to take a moment to share an insight that I got probably in my late 40s. And if I were smarter, I would have figured this out in my late 20s. And I always knew growing up that labor needed capital, right? I knew from lots of examples as a kid growing up that businesses needed money, right? That's the fuel in the tank. What it took me way too long to learn is that capital needs labor even more, right? Without the smart, dedicated, passionate, driven, high integrity, hardworking, risk-seeking entrepreneurs like Andreas, like Haley, there's trillions of dollars of capital out there of all different flavors that's making 1% on this money, right? It's really hard to get a market-beating return if you don't have some risk investment in your portfolio. So trillions of dollars in venture funds, in private equity funds, in sovereign wealth funds, in angel groups, in VC funds that are out there looking for the investment opportunities. In my view, it is the entrepreneur, not the capital, that is the scarce commodity in that conversation. And if you can go into those capital conversations politely, right, being the buyer and not the seller, knowing that you're actually bringing them what they want. Investors have tremendous FOMO over missing out on great deals. And all the talk is around how do we get deal flow? How do we find good deals, right? For us at Entrada, for example, we host office hours, which is how I met Andreas actually, to just meet entrepreneurs and get a sense of what they're doing, even if they're not raising capital yet. So investors have more fear of missing out on a great investment opportunity than entrepreneurs have of not getting capital. And I wish I had known that 20 years earlier, frankly. So Brett, what are some of the key differences between angel investors and venture capitalists?
Well, angel investors don't have LPs other than perhaps people at home.
Explain what that is for everybody, if you don't mind.
Sorry, limited partner. So, a venture capital firm, I'm relatively new to venture, but we have a $100 million fund that was raised probably across 30 parties, half of them being institutional investors. These are pension funds and the rest of them, and some high net worth individuals. Angels invest out of their own money. So a couple of things that are interesting in the difference. One, angel generally invest earlier and they're willing to take on more risk. They don't need a 10x return. They're probably looking at that investment vis-a-vis what their financial advisor is going to give them. And for an angel, to some extent, it's about financial diversification. It's an asset class. And obviously, generally, it's a lot early. Generally, angel investing, you don't have generally a GA product. You don't have a ton of customers. You generally don't have revenue. What angels are interested in is the concept, the idea, and most importantly, angels are interested in you. Angels bet on an individual because the likelihood of you having to pivot a couple times, it's a long road to Tipperary, are high. The largest angel successes I've had were literally over a 30-minute meal. By the end of 30 minutes, I knew this was somebody that was going to be successful. Venture, on the other hand, the interesting thing about venture, a venture firm to be successful needs to deliver 3x the invested money of its investors after fees. We charge 2 and 20. So that basically means that we charge 2% a year on the invested capital during the investing years, and we take 20% of the returns after 1x the return is delivered. However, what is interesting, if you look at a top tier venture return, and that usually is somewhere over, call it 3x, they usually 50 to 60% of the returns come out of 1 or 2 deals. So as a result, a venture firm has to believe you could be $100 million revenue business. They have to believe on the opportunity that you could be worth $1 billion. And if they don't, especially if it's seed or beyond, it's nothing personal to you as a entrepreneur. It's just not worth their time. So that's kind of how I think about the different things. Jason.
So we're going to come back and drill down on that a little bit more in terms
Yeah.
of what it takes to connect with a VC and what they're looking for. Haley, you have for the past couple of years now, you've had pretty engaged involvement, first with angel investors pretty substantially, and now with venture capitalists. How would you contrast that experience? I'm going to come back and ask you later what you wish you did differently, but for now, looking at your angels engaged with you and your VCs engaged with you, how's that experience been different?
Okay, between the two classes of investors. Also, are the AirPods better? Sorry to keep asking this question.
A
I'm
little
trying.
bit.
A little bit
bit.
better?
Yeah.
Okay, great. But yes, kind of speaking to the difference, I would say, I would mirror kind of the sentiments that everybody's had here, where the early stage angel investors that I brought in definitely are most interested in and loyal to the idea and myself. Whereas moving towards venture capital, it's become a lot more about the business, the growth. The question I keep getting is, how big can this get? I must have answered that 25 times in the last 2 months. Every one of those conversations is in pursuit of, will this be a unicorn company? So it's definitely a shift from earlier on, a lot more of the story, the narrative, the belief, the mission that we have as a by women, for women company. And now there's a lot more focus on KPIs and kind of guaranteeing that traction and that potential return. I've definitely kind of gone across the gambit. I've raised friends and family money, award money, true angel money, VC money, kind of gotten it all in. And I'd say another big difference across it comes down to investment size as well, which makes sense. The smaller investors that I brought on earlier on who are cutting 25 to 50K checks, I hear from them maybe once a quarter when I send out my update, and it's always just a good for you, you're still around. Like, they're just stoked that we've made it this far. So that's always nice. Whereas now, we're working with VCs that have put in close to $1 million and also some large angels in the 800K range as well. They're much more involved. They want weekly updates. They've got my phone number. They're texting me all the time with questions. And I forget who said this, but speaking to just the strings that come with raising money, when you've taken $800,000 to $1 million from someone, you've got to pick up that phone call. You've got to answer that text message. They definitely become a part of your life. And I guess we'll get to this later, but speaking to something I wish I'd known, they become really a part of your life. Like, definitely don't underestimate when you're taking large checks from someone. Expect to hear from them 3 times a week at 10 p.m. on Christmas Eve. Like, just be ready.
There are a lot of dating and marriage metaphors around investment, which we won't dive into, but it's very clear in my experience, and it sounds like in yours, once someone makes an investment in your company, that relationship is really for the life of the company or beyond, right? There's really no separating from people who have made substantial investment in your business. And I'm eager to dive into the VC side because I know that's kind of where the money is. But I think for many of the folks who are tuned in here with us today, angel investment is probably top of their list in terms of seeing that as a capital source. So a couple questions. Elizabeth, I would come back to you on this.
Jason, let me interject one.
Yeah.
I mean, I've gotten a lot of questions right around this. First, the angel investment, like SBAA, does it do it differently, or, the do's and don'ts, but seems like a lot of questions are coming from, what do they need to know? And maybe we're going to go into that, but it's worth the,
Yeah, I saw those questions as well. I was going to try and sort of pull those together into one here. There was one on sort of, is SBA looking more for software or hardware, and is the bar higher for hardware? I think we can come back to that one because it's pretty specific here. I would ask you, Elizabeth, what are the mistakes that startups make when pitching to angel investors?
The biggest mistake that I've seen is for the entrepreneur to be defensive. You can make a lot of mistakes with your financials and with your pitch deck and missing little pieces of it. But but you're probably getting a flavor from the comments of the panelists that angels are in it because they're passionate about looking at a company and helping it grow and really staying involved with the new ideas. And so to have somebody come in and pitch 25 or 30 people that are there kind of interested in wanting to help, and then have this wall saying, no, I thought of that already. I've done it. It's not a good idea. That kind of defensiveness, I've seen 25 people in a room shut down completely and just wait for the pitch to be over so that the person can be out of the room. So that's the only cardinal mistake I've seen. Everything else is around the edges. If you go in and you could do pre-work with an angel or two, you generally get coaching so that you have all the basics in the deck and can answer the questions. And angels are I think, are really tolerant of having a couple of glitches like that in a presentation and say, we'll go back in, a couple of months from now when you've had a little more traction here or there, why don't you come back and talk to us again? So, so not very many huge no-nos except for the one that I mentioned. There's a lot of things that you can get coaching on going to an angel that'll make you a better thinker about the basics of a early startup business that'll help you in that also.
I agree with you. There's a lot that we will tolerate in terms of unknowns and lack of experience, but the biggest turnoff for me personally as an investor is ego. Someone comes in like they've got it all figured out, and none of us have it all figured out. In fact, the less you have figured out. Yeah. In fact, I was in a meeting in an angel pitch a couple of years ago, and I would guess that some of the participants on the call today were in the same meeting, where I asked a question and the CEO responded by saying, "That is the stupidest question I've ever heard." I said that you should have no problem answering it, and it has turned out to be their greatest challenge. So ego is.
Was that Elon Musk?
So with that, let's kind of shift a little bit toward venture capital, because not only do we now have 3 folks on this call, at least pretending to be venture capitalists, we also have founders who are moving from kind of angel toward venture capital as their next stage of capital, and Elizabeth, who has been through the process of raising a bunch of it as well. So Brett, how should someone who doesn't know you, doesn't know Bonfire, doesn't have a personal relationship there, how do they contact the VC like you?
Look, I think it's an interesting question. There's been a lot of discussion actually in the last 3 years around, it was the last 3 months around sort of leveling the playing field. Historically, if you go to a venture capital website, there isn't a contact information. This is new to me. I'm like, there should be a lead form. You should talk to the individual. So the normal case is, 1, find somebody who knows them through LinkedIn and the rest of it. There should be some connection. An intro helps. 2, send them a note on LinkedIn, quite frankly. I think one of the issues around these networks, because the reality of most venture, it primarily goes to white males. And the reality is that diversity, if you look at from a return perspective, those companies that have diverse leadership teams perform better. So we're trying to break down this concept of sort of a private network. So for the first time in Bonfire's history, we actually have a contact on our website where you can actually send us a note. And I think we're seeing more and more of that. So it's not some weird secret club where you need some secret handshake.
So, for me, I've always wondered sort of what share of deals get done by something coming in over the transom that is not relationship driven. And my experience tells me that's super, super low, and that the best and perhaps really the only productive way to reach out to investors is, as you said, through an introduction, through a mutual friend, which is what makes LinkedIn such a powerful tool. Dan, I would ask you the same question, right? What is the right way for someone who doesn't know you, or someone with your profile now running a venture fund of this size? What's the right way for them to contact you if you don't know?
Well, they have the option of going to the website, SantaBarbaraVP.com, and just using the contact form, and it goes directly to me in my case. But that's not necessarily going to get them started off in terms of having credibility, because they're just sort of someone that I don't know. but it's an option. The best way is, yeah, going through somebody else that I already have a relationship with who can vouch for them, because it's not just somebody that is kind of a stranger. But either way, we'll look at any opportunity because you never know where a hidden gem's going to come from. It doesn't always come from the normal channels. So
Yeah,
we wouldn't want to be dismissing something that could be great just because someone doesn't know me or a friend of mine.
And I know Andreas has been through exactly that process. I just saw an interesting comment pop by from Rick Tico, which really triggered something for me, which is in addition to sort of friendly contacts, it is often sort of the folks that are in that service provider role, and I don't mean that in a diminishing way at all, but I mean the accountants, the lawyers, the bankers who are aware of an interesting early stage company because they've incorporated them, they bank them, whatever it is, and having that network of service providers who can surface interesting opportunities before the rest of the world gets to see them is also a very valuable source of deal flow, right? Going back to our FOMO issue as investors. So Rick, thanks for bringing that up. Andreas, you've been through this process of essentially reaching out to venture investors, right? Funds and people you didn't know before. You've had some success with that. You've hit your head against a bunch of walls doing it. What advice do you have around that?
Well, get really used to hearing no. I think that's that's one. And so what did I learn? Well, so a little bit of history. So we've to date raised about $5.5 million to date, and then another $500,000 in grants for our Canadian subsidiary. So that $5.5 million has come from crowdfunding like Indiegogo. It's come from angel investors, family offices, a foundation, and it's come from a couple of high net worth super angels and a micro VC. So not a large cap table, but essentially it's a motley crew, I guess, of a different, look for the pattern. And ultimately the only pattern that we've had in our fundraising is that we found that everybody either has, they're 1 or 2 degrees separated from somebody with a disability. So they implicitly know what it feels like to have someone not be able to communicate or be in a wheelchair. So there's an implicit understanding that we don't have to overcome explaining the why of why we're investing, right? Like they know it, they feel it. And so there's an instant kind of filter when you start to say, well, we've got to go raise capital. How do we make sure that we're aligning to values, right? So ultimately, whether it's an angel or a VC, with an angel, we're aligning around core principles and values. Do we want to solve this problem? Do we want to work together? Do we enjoy, is this a risk we want to take together? When we're going to VC, we're specifically researching them. Like we're Google stalking, not just the fund, but who is the partner at the fund, learning about who that partner is, understanding, do they have history investing in our kind of technology? Do they have an actual thesis that kind of lines up with where we're going? And then does the fund that partner works at, do they write checks the size that we need? Are they sort of that Goldilocks of too early, too late? And are we kind of within that range of good fit? And then the last thing is, do they have a history of leading rounds or do they have a history of participating in co-investing? And then trying to figure out, is there a network effect of co-investment? So if you say, I'm trying to raise funds from these 5 VCs and 2 of the VCs have invested in a company together that I like, and I know someone at that startup, then you kind of work your way in from the back to say, is there an entrepreneurial friendship relationship that 2 VCs that have invested in your friend's company might take your call? So there's a lot of this just data science and just not accepting no and figuring out that no doesn't mean no. No is usually no, not now, or no, not this way. So, and just being persistent and know that you're going to hear no a lot and be okay with it because no is a gift, right?
Yeah, it's that triggers for me a bunch of other questions I had for you guys. And also we all have our war stories, our funny ones and our tough ones. And I would love to crack a beer and sit here and regale people with stories about, how we met Mark Suster and raised capital for Invoca, and how we met Mark Andreessen and raised capital for Appeal. And there are awesome stories behind all of those. But I think what probably is top of mind for many of the folks who are listening in now is this very ambiguous $5 million question of what sort of progress, what sort of traction does a company need to demonstrate in order to be ready to have a venture capital conversation. I'd kind of like to throw that out to both Brett and Elizabeth, having been recently on both sides of that. And Brett, you go first. I mean, what from a VC perspective is the type of traction you're looking for to have a credible conversation with the company?
Yeah, I mean, I think it depends what type of VC, right? If you're looking at pre-seed, there are pre-seed VC firms. You could have a conversation sub 50,000 in annual recurring revenue. I mean, I'm talking about from a software perspective. When you're talking to a seed firm that's looking to, let's say, write a $1 to $2 million check in a $3 million round, they're looking for, I'd call 20 to 40K in recurring revenue. I think the most important thing as part of that is they want to be able to talk to 3 to 5 paying customers that they can talk to and validate. Because still, even at seed, you might be 3 years in your journey. Whatever spreadsheet you have in your financial model, like, it's fun to look at to understand if the logic makes sense. But we're just making it up at this point. You're still very early in your journey. And so it's still very much of an emotional investment for a seed investor, but they need to basically look at your revenue and vet that with 3 to 5 customers that are as excited about your product or offering as they are. So that's kind of the revenue that we look at. The only one where I'd say it's different over the last 5 to 10 years is there are a lot of product-led startups. Think of Coda and other companies like that, where you're going after users first, and they may be free, and there may be a freemium model. And so you may not have as much revenue, but in that case, you do need to show a good level of user sign-up traction and monthly active users, and have at least a thesis around how you would monetize those users.
So that makes perfect sense. And staying focused here on the focus here of being early stage capital journey for companies. Elizabeth, what sort of traction do you feel like you've had to demonstrate over the years and over the companies to have credible venture capital conversations?
Yeah. It's interesting. Just to clarify for the audience, in case there are people that aren't familiar with the various stages of venture capital, Brett mentioned seed to pre-seed. So the stages are kind of graded by letters, through to companies that sometimes I think go out to E, unfortunately, because that generally means they haven't gotten the exit that they need to. But
they passed E and had a great successful outcome anyway.
Yeah, exactly. But they're generally correlated with amount of money and stage of growth of the company, those stages of venture capital. And to me, when I've been out raising and trying to go from one to another, it's goes from demonstrating traction to then having a story about how that traction is going to get you into a sustainable, bigger market. So you're showing that you can actually have product value fit in either multiple markets or a big market, and start making inroads to that. So it goes from just your insular, you've got a foundation and you've got a nice company that's going to be stable, and then it goes into you can show a bigger exit, and then you can start getting into the $10 million investments and on up from that. But to me, it's all about the potential for the company and the clear path to an exit, because venture capitalists don't want to be as much as you might love them. And I'm speaking from HD Insights. I've got a terrific board right now. They don't want to be with me their whole lives. They're looking for return on their investment, because they want to go on to the next thing. That's their business.
So I have follow-up questions on that, but I see Leslie lighting up over here, so she must have a good one.
Yes. So a number of questions wrap around, there's a difference between a high-tech company, a company that's software. How right now, how do you look at investing in one versus the other? And that, might be SBAA or a venture capital company, but very valid question.
Yeah, who would like to jump on that? I think, Dan, you probably got a pretty good perspective there.
So get the question right, that she's asking about industry preferences beyond, for example, software?
Yeah, I mean,
Is that right? Okay.
how do you treat that investment difference?
I'm sorry.
How do you treat that investment? I mean, it's different, the high tech versus software.
Yeah. Yeah. So, in my case, I look at across all industries. I have a preference for software, and a lot of investors do, because there's all sorts of advantages to software from an investor standpoint. But outside of that, I think it's a question of seeing what the traction is, and things like what is the valuation that the seller of the business or equity of the business is expecting. Because if they're appropriately accounting for the industry they're in that might, for example, not value itself for every dollar of revenue the same way a software business does or a tech business does, then there's nothing wrong with looking at the excitement that can be in a more traditional business, or something that has absolutely nothing to do with software or even technology enabled. So, again, we've talked about Appeal Sciences before. That's a material science business, and they had a particular solution, even though they didn't have customers in the beginning. You were sold on the fact that if they were able to execute from a product standpoint and scale the product that they had, there would be no question about demand. It would just be ubiquitous. And so when you have that kind of situation and you can see $1 billion potential outcome or $500 million potential outcome, even when there isn't necessarily a whole lot of early stage traction, if there's proof of demand, there's a company I've been looking at investing in now that they don't have a whole heck of a lot of revenue, but they have $1 billion in pre-orders. Now, those pre-orders may not come to fruition. In order to, they have to execute on the product. But, that's a lot different from an early stage company that both doesn't have product and doesn't know if the customers are going to show up.
So that is great. And also, I'm taking a note here. Leslie, your question triggered something for me. I was going to pop in here for just a few seconds and we'll come back to the panelists. Great reference to Appeal Sciences, right? That is what Appeal is doing is probably the most incredible thing that I've ever seen. And in its early days, it was not a software company, right? I would absolutely say it's a technology company, but it was not a software company where I've spent most of my career, and I appreciate those multiples and those margins. And that's where I got comfortable as an entrepreneur and as an investor. I'm fortunate with Entrada here to have a couple of super smart, nerdy partners in Alex Fong and Greg Fish, who have given us as an investing team the confidence to look at harder technology deals in networking, in photonics, in chemistry, in physics, and things that I wouldn't have the confidence personally to go and lead investment in. But for me, and I think for a lot of the investors I know, when I look at that investing sort of pie chart, what I base my investing decisions on today, first as an angel and now as a venture investor, I will say that pie chart is 85+% people, because the technology is going to change and the market's going to change and the product's going to change and the capital's going to change, right? What's not going to change, at least not without a crowbar, is the founding leadership team. And to me, that is overwhelmingly the most important criterion for investment. And I've moved at this stage in my career, which makes me sound old, and I think I am getting there, frankly. I only want to invest these days in things I actually find interesting and want to spend the next 5 to 10 years learning about and leveraging my network, my contacts, and my capital to support a story that I want to be out telling as well. And that's exactly what the experience with a company like Appeal Sciences has been like. We have another company in the portfolio at Entrada that is a different type of material science company and a similar profile. And I can't wait to be out sharing that story with the world as well. So it's a very people-driven decision process, I think, for most. So a question that has come up a couple of times here that I think is a sort of a natural evolution from here, as you talk about how long investors want to be engaged with your company, even if they love you. The question that you get in capital pitch meetings that you don't want to get and you don't know the right answer to, and you don't know if it's a trap, is what's your exit strategy? I'd love to drop John Patotti's kind of famous question here, but I'm going to toss it out instead to Haley. How do you answer that question, right? You're in your pitch meeting and someone says, what's your exit strategy? What's the right answer that keeps the meeting on track?
So Oh gosh, it's always a moving target on that question. One of the running jokes I usually say is the exit strategy is whatever option makes your investment the most profitable, right? That one tends to do decently well. But no, I think it depends very much on, again, the type of business that you're running and understanding where you fit into the market and what's the most realistic way that the business is going to mature. So for us in particular, making footwear, I definitely appreciate that the largest value add that we bring into the footwear space in Passion is utility protection. So as I mentioned, we're patent pending in 30 countries. As you guys can imagine, what high heel has a patentable aspect to it? All of these fashion brands in the market are constantly just fighting each other to have the best design, the most brand loyalty, competing on these more intangible assets. So to have an actual firm utility function that we can bring into the space that provides measurable value to the consumer, that's incredibly competitive. And that's what is the main thesis behind our valuation. So with that in mind and knowing that's our strong point, it's natural to assume that our target exit will be an acquisition. For a big brand like, a Steve Madden maybe is the one I throw out as an example. For him to be able to have a defensible competitive edge over Sam Edelman, who he's been fighting with for market share for the last 3 decades, that's worth a lot to him. So, when we think about the possibility of an IPO or something like that as an exit, the reality is by the time we were large enough that we'd be looking at that route, we'd be making such a splash in the market that we'd most likely be getting approached as a competitive advantage to the acquirer. So that's most likely how we'll exit. But I think that answer is very unique to each company. I think it's really, you have to analyze what your strengths are, why are people buying into you, what is setting your company apart, and what's your niche in the market. And is that something that a competitive brand would want to purchase, or can you run crazy to IPO?
Yep. Andreas, I got to mess with you a little bit. Fascinating company. What's your exit strategy?
You want to know, don't you? Well, I mean, it's like you're playing poker and you only have so many hands, right? So, I mean, ultimately, it's your exits are you IPO, you get acquired, or you essentially just keep running and you just build a really kick-ass business, And I think those are really the outcomes that you're striving for. For a company like ours, I don't see our company kind of like Haley. I don't see our company. There are companies that have set a precedent in this kind of deep tech, med tech space that have IPO'd, right? But realistically, the multiples are there that are better for everyone through an acquisition, right? And so if you look at, I show one example. So there's a friend of mine who worked for a company called Control Labs, and Control Labs, they make a little armband that has EMG sensors on it. And so, they were just, they spent a few years building this armband. They raised 60 million in capital and Facebook bought them for $1 billion. So 500 million cash and 500 in earnouts, so that they could deploy their armbands. Essentially, I mean, this is, I'm not disclosing anything, but it's, if you think about an Oculus, these big companies are basically betting on the next operating system, saying that virtual reality, augmented reality, it's the next big thing. It's the next computing platform. But then you have these clunky interface things that are out there that people have to deal with, and they suck, right? And so a lot of the big tech companies, Microsoft, Amazon, Apple, Google, Facebook, they're all investing in platforms, right? They're all investing in becoming the next platform play. So if you think about an acquisition, sometimes you have to understand, well, is what we're building, we're focused right now on building tremendous value for 500 million people with disabilities. But what's cool is that because of the problem we're solving, we can actually generalize that problem into a mass market capability, right? So if you think about these technologies are all going to be fighting each other, converging on this augmented reality interface, you're going to need to be able to control your augmented reality somehow, right? Either through gestures, eye movement, head movement, or your brain. And so we've got the IP established as essentially a linchpin to say, if you ever want to have neurotechnology as a control interface for augmented reality, cognition's it. So so that's kind of in our back pocket. But right now we're like, let's apply this technology to build a solid business selling technology through insurance, because there's trillions of dollars that are there, and there's existing codes. So we're not getting de novo codes. There's existing codes we can map to, so we can execute like right away. So we kind of see the optionality to say, let's focus on building a killer business. And if those opportunities present themselves where there's overtures, we would be open to it for the right price.
I think that's
Jason, I could share some thoughts on it as well from the VC perspective,
Yep,
but
let's do
I didn't mean to cut you off. So I disagree on the IPO part of the answer. Experienced investors know that almost nobody ends up IPOing. It sounds wonderful, but even those companies that are on the slate to IPO, there's like 500 of them right now all lined up, and very few of them will end up. The vast majority will never IPO. And those are the 500 most likely to IPO in the world. So it's really not a very realistic outcome that one should plan for. In terms of the answer to that question, I think what investors want to know, especially venture capitalists, is that, yeah, you're looking for an exit at some point, but you're not satisfied with an exit that's anywhere below where your investors are likely to be satisfied with an exit. So maybe for you personally to get a few $1 million out of your business, you're good to go. You'd love to get out, but your investors investing at a certain price at a certain point, and they need to get a wonderful return from that point. And so while it's great for you, it's not going to be great for the investor. And that's really what you have to be thinking about. And I think also part of the answer is not just, we don't want to sell this company until it hits X, but then it's also building a case for how it's going to build X, and then who's going to be buying it. So here's how we're going to be able to sell at X plus whatever in 3 years. Here are all the people that have bought companies in our space. Here's why they're going to need our company in 3 years. That's the kind of information that you want to get across to your investors when you're trying to answer that question.
There are multiple different perspectives here. There's no right answer, which is hopefully one of the takeaways you get from this. It is very subject to the nature of the investor you're talking with, what their expectations are, the valuation, the stage of company. I can tell you when we were meeting with Excel partners up in Silicon Valley to ultimately lead Invoca's Series C round. In early meetings, we were up whiteboarding extensively with their partners, the company's exit strategy and who those buyers look like and what their revenue multiples are and what we need to achieve to get there, right? So it varies. And a couple things come up for me here. There's actually been some really good input from the folks that are listening in. One of which, before it kind of scrolls by, I really want to call out. Adam Kearney had put one of my very favorite quotes here, and one of my partners, Brian Coriat, is very fond of this, and it's an incredibly astute guideline for raising capital. And it's simply that if you want money, ask for advice. If you want advice, ask for money. And it really, really is true. You're looking to engage these investors as partners in your business, not just as checkbooks. And so that's something that really resonates with me each time I hear it, and maybe stick that in your back pockets there. Another question that's come up, and I actually want to throw this out for Brett, I think, and maybe Elizabeth as well, since you've been through this in this cycle. We hear a lot about COVID and headwinds, right? And you look at SEC filings, and it's not fun being a public company, as Dan kind of mentioned. I've had the chance to go through that a couple of times, and IPO is not as fun as M&A for founding teams. But if you read the SEC filings, the 10Ks and Qs, lots and lots and lots of references to headwinds and COVID, et cetera, et cetera. I think it's easy for folks who are having trouble raising early stage capital to want to blame the environment and say it's just harder now, right? It's not me, things are different. How different do you find it, Brett, from a venture investor perspective? How has COVID impacted your investment processes, volumes, ratios, theses across the board? How's it impacting you?
Yeah, so look, like you, Jason, we invest early, right? So we're investing in a company, it's over a 10-year horizon. So hopefully somebody has an idea that has value pre and post COVID. That being said, I do think COVID has woken us all up to the reality that it's probably likely that most companies' future, when there's a vaccine and the pandemic is not with us, is not what it's been for the last 100 years, which is I have a physical office location and I'm going to hire employees only that are within a 60-minute commute. So I think what we have seen is an explosion in companies around, if this is some level of the new normal, and there will be some hybrid level of that, that's going to represent a very different way of operating. So obviously technologies that can help on that level, I think are going to be high. I think the second thing that we're seeing quite a bit, there's a funding boom for mental health startups. Sort of COVID, I mean, not to say that mental health was taboo before, but I think with COVID and the rest of it, we're all kind of struggling a bit. And so I think there's a ton of investments in mental health. It is a weird thing though, as an early stage investor, and you might see this well, Jason, which is I sort of wake up each day, I look at the news and I try to figure out what's going on in the country and I have to go, blah, blah, blah. And then I am in the most frothy funding cycle in software that's probably existed in the last 25 years. So SaaS is doing quite well. So I don't know if you've looked at the multiples, I know Dan has, but the public's multiples for SaaS companies is at all-time high. And I think to some extent, COVID has accelerated the move to, if you will, a digital world or software indeed eating the world.
So I agree with you. And frankly, I mean, I'm sort of watching the clock here, and I wish I could spend the time interviewing each of you for an hour and a half, because everyone has some really great experience here to share, especially us older guys here. But there's two areas I'd love to focus on in the kind of 15, 20 minutes we have remaining. And I see Leslie, she must have a question. Go for it.
Yeah, we just want to make sure we've got our audience questions included. This is orthogonal, but very relevant. A question from a group that's VCs or angels in San Luis, that when do you, or if you do not, change your CEO or your senior management group in a company to be prepared for VCs or opening up to an IPO, that sort of level? Question asked. Is that clear?
Yeah, and I know that a couple of folks on this panel have direct experience with that, and I'm sensitive to taking too much of Brett's input here, but I know from personal experience, in fact, as I transitioned out as CEO at Invoca, that was a board level discussion about the future of the company and what skill set we wanted in there in leadership to take it to the next level of going from startup to rapidly scaling larger organization. I can tell you from an investor standpoint, you never want to replace a CEO. It is incredibly painful. You lose traction in the business. You lose the support of key people. Sometimes entrepreneurs think, oh, I don't want investors in because they want to take control of my company. It is absolutely the last thing an investor ever wants to do, is have to run your company, to change out the passionate, visionary founding leadership and bring in someone else because somewhere along the road, that skill set had a flat tire, right? I watch companies like Appeal grow, for example, having known James Rogers and Jenny Du and Lou Perez and the founding team there for 7 or so years now. Young team, right? Big question mark. This is a huge market opportunity, the least demand constrained business I've ever seen. Can this team grow to scale, to lead a global organization? And I get goosebumps thinking about it, because at a dinner with James the other night, I've never been more confident in his ability and that team's ability to scale leadership as the company scales as I am today. It would be a disaster if we needed to go down a path as a board or as investors of thinking about changing out leadership teams. So yes, it does happen. And I want to sort of flip it to Brett for a perspective here. But
we invest in founders, not ideas. We can supplement a founder as long as they're somewhat open and aware. There was a question around blind spots. We all have them. It's much easier to surround an amazing founder with people that have run the playbook before. But startups are not rational. These are like crazy emotional journeys. They're very personal. They're very emotional. They're very hard. It's like, and so, but there's nothing that replaces the energy and the soul of a founder. And so we look to supplement. Now, that being said, the best founders at some point, when you get to a certain size, may say, you know what? Like Spicer at Snowflake was like, if I can get Frank Slootman to come from ServiceNow, we could be worth, I don't know, $80 billion in 18 months. So there are always examples, but we invest in founders and we do not like replacing CEOs.
So we're all friends here, right? Us and the couple hundred people who are sitting here having conversations with us. So Elizabeth, I'm going to ask you if you're willing to share just a minute or two about your experience coming in as sort of a next stage CEO into a company that was founded by someone else who then remains productively engaged with the business. I mean,
Yeah.
what was that experience?
Yeah. I thought that question might be coming my way. So I agree with Brett that changing out a founder is fraught with landmines. And I've had experiences with companies over the years where that's had to happen. And it has been a speed bump for the company that lasts 12 to 18 months. So as Jason insinuated, I came in and took over for the founder, Craig Harris, who had at that time run the company for just about 6 years, about 6 years old. And one of my worries was just all the things that we've been talking about, how this is generally not a good situation. But there are exceptions to the rule, and you should all understand that also. So even as an entrepreneur, you might get to the point in your company where you're not comfortable with your own skill set, or you just don't like what you have to do at the next stage of growth in the company. And Craig, who is incredibly astute and has built the IP in HD Insights, is also very self-aware and got to the point in running the company that he really knew he didn't like having to make the kind of decisions that you have to make to scale a company. And that's very different from the kind of decisions you're making to get a company fundamentally started. So with that as a backdrop, the board was supportive with him moving aside and bringing in somebody that thrived and really enjoys the operational aspects and sort of the tough moving pieces around to get the company going. But the key to it all was Craig and his support of the transition. So there was never a time where he did anything but be very, very supportive of the kind of calls that I had to make. And there were some really tough ones early on where it was very emotional for him. And we had a lot of heart-to-hearts behind closed doors. But when those doors opened, he was chairman of the board, I was a CEO, and we were a united front. So it takes a special combination. But there are good exceptions, and we're quite successful right now. So I think the transition has been a positive one, and for the company, for Craig, and for me. So it can be done.
It's never clean and simple, and there is no playbook for transitions as companies grow, and we've all been through them. It's not to be feared because your investors, your board, your team all have the same interest at heart, which is the long-term, scalable, sustainable success of the company. And what I learned a couple times is, you really got to be thinking with your wallet and not your ego as we're all making those decisions. So in the time we have left, there's sort of two areas I'd love to have us touch on. One is a little bit more experiential, and that is primarily for Andreas and for Haley, sharing what the experience is like really to be operating an early stage company on someone else's capital at a loss. And for the folks who haven't had that experience, and I think everyone on our panel here has, but you guys are doing it right now. For the folks who haven't had that experience yet, that sounds crazy scary. What's it feel like to be operating a company at a loss as you grow on someone else's capital? Andreas? You're muted.
Sorry. Yeah, it's super stressful, just to be honest. But I think it goes back to recognizing what your business model is, right? What you're trying to build, understanding that you're honest with. If you're discovering molecules, right, or you're doing some invasive thing that requires regulatory control, you're going to be going years with no revenue. And you have to be honest that that's the business model, and you need to capitalize appropriately, and you need to set expectations, right? And that means finding investors that aren't looking for, if you're building a med tech company, you're not looking for someone who wants a return in 2 years. So understanding sort of that long-term nature of the type of business model you have. And that's what allows me to sleep a little easier at night, is understanding that you got to be totally honest up and down around on what you're doing, what you're building. But you're always looking for, how can I, if there's a whole shot opportunity to leapfrog industry standards or history, sometimes you learn a lot from history, but you can also create history with the right enabling conditions. And so I think being creative and understanding the business model and saying, I'm sure people on the call or that are listening are familiar with the business model canvas, right? You have these quadrants around the business model. I think there's areas that you can innovate and disrupt industries just even in one or two of those specific areas, right? So, how do you have competitive advantage in distribution, or competitive advantage in contracts, or in the network effect, or competitive advantage in just features, or there's IP or patents. So there's understanding how you can create leverage that could maybe catapult you into an opportunity where you can accelerate growth or accelerate sales in a way that your competitors haven't been able to. So one example is, we have a competitor that's based in Sweden. They're publicly traded. It took them 14 years, right, to get to $100 million in revenue, right? But they sort of blazed the trail. They created the model, but they're generating around $200 million a year now in revenue, but they have about 3% market share. Right. So there's this blue ocean of what can we learn from what they've created, and understand how we can either fast follow what they've done, or we can play a couple of other steps to maybe do what they did faster. And so I think that's where the creativity of, when you're starting up a company from the very beginning, understanding you have a playbook and a roadmap in your mind, and saying, this is what we're playing. And there's some things that are pretty well fixed, and certain things that we're going to be testing. And so I think staying focused on the plan, and staying focused on understanding what knobs and sliders you can turn in the business, also helps kind of take the stress away. Because I think if you're idle and you're not actually driving, you get stressed out, right? But if you're in the business and you're, like Haley can probably relate, I was up till since 5:30 this morning, right? And it's like, I don't have time really to get stressed out. I have to just think about, like, what are we doing to execute? So, anyway, I'll leave it at that and pass it to Haley, because I think there's
Haley, operating a startup has sort of been compared to, jumping off a cliff and building the airplane on your way down, sort of thing. You have an early stage company, you're scaling rapidly, you're operating at a loss, you're dealing with terms like runway and burn rates and other things like that would keep a lot of people up at night. You're also hiring, right? How do you convince you're hiring for a head of product or design or something. How do you convince someone to put their career in your hands, where your company will be out of money in X number of months if you don't keep working the magic? How do you do that as a startup CEO?
So on the hiring side or on the investment side?
We got the investment stuff, but on the hiring side, how do you, as a CEO, founder, leader, how do you have the confidence to convince someone to quit their safe job and come join you when you happen to have only X months worth of money in the bank, unless you keep working your magic?
Sure. I definitely see one of my main roles as CEO as providing a really clear vision for the company, the path forward, and what this is going to be. To your point about having confidence in it, the reason I'm a startup founder and CEO and I've thrown myself off the cliff while I'm building the plane is because I am insanely, undeniably, and irrationally confident in that fact. So for me, my job really is to bring that same level of commitment and confidence to the people that are coming on. And I think if you're doing your job as CEO, you have to be able to sell your idea so much to someone that they are stoked to come work for you and take a pay cut in exchange for a stock option. Because by the time you've painted the picture of your vision, they firmly believe that that option is going to be worth millions, if not billions of dollars by the time all is said and done. So
and that is
that's the primary function of my role.
Yep, I agree with you 100%. So we have the Appreciate demo starting up, and I can see 4 minutes, and that's going to start on time. So What I would love to do is, there's a lot of the tactical stuff we just didn't have the chance to get to today about safes versus notes versus equity rounds and all the things that people need to know to go raise capital. But in the couple of minutes we have here, I would love to kind of go back around once for everyone to take, 30, 60 seconds on sharing the most actionable advice or guidance you would have to a founder who is looking to raise early stage capital right now. And Haley, you're already mic'd up, so why don't you go first?
Sure. I was going to say, kind of as I hinted at earlier, don't underestimate how much time you're going to be spending with potential investors. So there's a couple things on that. One, get dinner with them, get happy hour with them. Don't take their money if you're not confident essentially being married to them and talking to them all the time. You do want to like them. Furthermore, try to make sure they're bringing more to the table than just money. If you're going to be having 5-6 conversations with this person a week, you want to be able to get the best bang for your buck. So if they have relevant experience to your industry, that just is icing on top of the cake. And then one other big tip, I've made this mistake multiple times, try to raise money when you don't need it. Raising money when you need it is a real pain in the ass.
That is 100% true. Thank you. And thank you for joining us tonight. Elizabeth, what guidance do you have for folks who are out raising early stage capital now?
Yeah, I think we've said it during the panel, but don't give up. I mean, Andreas was saying you get a lot of no's, but you learn from those no's and coming back even to the same people as you progress a little bit to have those discussions. It's going to take time. So be persistent and be passionate, as Haley said, about your idea. And things will fall in line. There happens to be a lot of funding out there at this period in time, so don't give up.
And Brett, who frankly, got to call you out here, you've been sort of a touchstone for me, particularly in the area of scaling operations and sales ops, we had a critical need when you came on board in Invoca, and have been kind of a mentor for me here as well. Your bio, I think, that you gave sold you a little bit short. I don't know that most people realize you were effectively part of Salesforce.com when it was a startup and rode that to really substantial growth there. What advice do you have for folks who are seeking early stage capital right now?
Look, I think you got to manage your energy. Raising money is hard. You're going to get a ton of no's, and it's not personal, although it feels personal. As an example, I will meet with 300 founders this year, and I will say yes to 3. So what's important to understand, and I've raised money unsuccessfully and successfully as an entrepreneur, you just need to be yourself and manage that energy. Because when you're not raising money and you've got employees looking to you, et cetera, you've got to find a way to manage that energy. In terms of having an effective the most effective thing, this is what we look for. Is one, own your narrative, your story, the emotion around the story about why this now matters most. I would say I will make a yes or no decision within the first 3 minutes of talking to a founder. Do I like them? Do I like their energy? And can they explain why is it they're doing this? You want to hook us. Second, who is your team? Who is the team that you have or will assemble? Because we need to believe that this team is going to execute that story. Third, look, if you're in the software business, you need to have a well-designed product that's easy to understand, use, love. And whatever your go-to-market motion is, don't come up with silly answers. If you're raising $1 million and somebody says, how are you going to go to market? And you say, I'm going to sell to small companies, medium companies, and large companies across B2B and B2C in every country around the world, it's laughable. Understand that early on, we want to figure out what is your initial motion that you're going to make work. And it's fine to start in one place because you're going to have to align sales, marketing, success, and product around that. What founders often do is overshoot the moon because they think that's what we want to hear. So that's kind of the advice I would give.
Well, that's great. And I would love to wrap back with Andreas and Dan. I'm getting the hook here because it's time for the Appreciate demo to start. And I don't want to give some time for Steve to wrap up here. Frankly, the time has flown by. I would love to have had a chance to go deeper on this with each of you. And perhaps there's more we can follow up on, and we'll find a way to get your contact information out to those folks who have participated tonight and would like to contact. So we'll do a follow-up on that. Thank you guys so much. With that, I'm going to hand it back to Steve here.
Thanks so much, Jason. Wow, that was a really fantastic program. And I hope everybody can join me in giving the panelists and our moderator a really big round of applause. I wish for the sake of our panelists and our moderator, that you guys could get that kind of feedback. The best that we can do is give you the Appreciate Social. I don't know if it's open yet, but we'll be flipping over soon. Certainly in the chat stream, it's all been there. Before I say goodnight to everyone, I want to remind you that our next event for the MIT Enterprise Forum of the Central Coast is on Wednesday, November 18th. The topic is building a successful medical device business in Santa Barbara. We've got a really fantastic panel. Go to mitcentralcoast.org for more information, to sign up and what have you. Look ahead, we've got a whole calendar ahead of us. We are working hard to put together some real live networking events. The one that we did in August was a lot of fun, and we're hoping we can pull off another one. With that, I wish everyone a wonderful good night, good health, and I'll see you in Appreciate Social.